What is the Fed funds rate? Does the Fed increasing that rate mean mortgage interest rates go up the same amount? And should you protect yourself before the next Fed rate hike? Well, let's get into all of that and dispel some myth information, I like to call it, out there in this week's Market Update. All right, so I get this question a lot, and people are concerned. My clients are concerned. You're like, hey, wait a second, the Fed's about to raise the rate again. I better get a contract before that happens. And many people also think the last couple of years when the Fed rate's at zero, all of a sudden, interest rates are going to go lower because of that too. And that's not always the case. So let's talk about that. The Fed funds rate is the overnight rate that banks borrow money from each other. That rate directly affects things like lines of credit, credit cards, car loans. When that moves up and down, that's going to change those interest rates and ARM loans immediately, right? But because of the dynamics in the financial market and the way mortgage interest rates, which is long-term money tied to really bonds, mortgage-backed securities, that's what interest rates are tied to, it doesn't always work the same. A lot of it has to do with what is the expected Fed funds rate change going to be, either a hike or lowering the rate versus what actually happens. So the Fed rate is the only real tool that we have to fight inflation. And inflation is the arch enemy of mortgage bonds, therefore interest rates, right? So as inflation gets out of control, interest rates go up. You have seen that this year. I'm recording this here in September of 2022, and we went from 1.4% inflation almost 2 years ago to 8.3% inflation now. And a lot of that happened in the last 12 months. And you've seen rates increase because of that. Really since November of 2021. And then the last 6 months, we've just seen rates double, right? So a couple of key points though, and we're going to look at the charts here. You can see on this chart, this goes back to March, because March was the first Fed funds rate hike this year. It was expected that they were going to keep the Fed run at 0 up to 0.25%. The Fed ended up raising the interest rate 0.25%, right? The first hike since 2018. First move since 2018. Then in June, middle of June, June 15th, they made another hike, and then in August another one, and they're about to make another one, tomorrow, but you'll probably get in this video after that. So it was expected, and so you can see in the charts, prices actually moved a little bit. This is a price chart you're looking at, so the higher the price, the lower the rates, and vice versa. So prices actually moved up a little bit, but it wasn't enough based on the fear of inflation, and so prices fell after that, right? But then if you look what happened in June, the Fed was expected to increase it by about 0.5%, and they increased it 0.75%. So that is hawkish. That was higher than expected. Okay, the Fed's going to get serious. It's going to fight inflation. That's what the market thinks. These are market expectations. And so because of that, there was a great bond rally, and we actually saw the first big rally of the year in mortgage bonds, and prices improved 250 basis points. So rates dropped 0.5%, right, in just a couple of weeks. And then it stabilized. And then in August, or into July, really, into July, on that meeting, it was expected they would raise it about 0.75%, a half to 0.75, and they ended up raising it 0.75%. So again, we saw a small rally. Now, it wasn't able to combat the next inflation reports that came out a week or so later, which were worse than expected. But as you can see from just this year, just because the Fed raises interest rates doesn't mean that, or more Fed rates doesn't mean long-term 30-year fixed, 15-year fixed mortgage interest rates are going to go up. And one of the things we do here that we're really good at is understanding that, understanding stochastics, understanding technical analysis, what's going on in the economy, and what the expectations are versus what the actual rates are going to change, and how that's going to affect the mortgage interest rate. So I hope that's helpful. Do not be necessarily nervous, right, that the Fed is going to raise the Fed funds rate and then now your rate's going to jump up 0.75%, right? If that were true, the last 5 years when Feds be at 0%, interest rates would be at 0. And that's just not how it works, right? And so We will monitor that for you and keep you posted, but know that the Fed hiking the Fed funds rate, if it's hawkish more than expected and it actually fights inflation, that is good for mortgage interest rates. I know it makes challenges in the rest of your world, okay? But for mortgage interest rate, it can actually be good. When they're more dovish, or they don't hike it as much as they should or as much as the market expects, that's when you can see, in the short term at least, that will be mortgage interest rates get a little bit higher. So if you have any questions, of course, we're always here for you. Hopefully this helps you, educate you, your clients, people in your life. And if you have any other questions, of course, hey, we're just a phone call away if you need us. We appreciate you, and we hope you're doing well out there, and know that we're in your corner, and we're here to help you in any way we can. Cheers.